What's going on, y'all? Today I'm going to be going over the trade I took yesterday, the sale that I caught yesterday, February 11th, 2026. And I'm not going to show the live trade today because I didn't record it, and I wanted to show y'all the execution that I took the trade, but it's also not letting me show my executions. So this is the trade that I took. I had an entry here, stop loss here, and I targeted these lows over here. And the reason why I want to go over this trade is because I was seeing when I went on like Instagram and everything like that, a lot of people thought that the bias was going to be bullish today, and I completely had a bearish bias. And the reason that people thought it was going to be a bullish bias is because right off 8:30 opening, we have a sweep under these lows right here, respecting this fair value gap. And then we have a run higher, and then that run higher is, if I get rid of this right here, that run higher is coming above these highs. And then a lot of people thought that this was going to be the buy side that it was going to be running. That's why a lot of people was bullish on that run higher that started at 8:30. But I had a complete bearish bias, and that's what this video is going to be about. I'm going to show y'all how to be better with having like your daily bias and picking the right direction on a given day. So my theory going into the day was bearish, and the reason why for that is because you see this big range that I have on the chart from high to low. So you got your high end 75%, 50%, 25%, and then 0% the low end of the range. So what I use these ranges for is to measure the premium and a discount of a single range. And how I use it is, if I'm above 50%, then I'm looking for shorts only. I'm not looking to long inside of a premium, because I'm typically looking for a larger run in between like 60 through like 200 points. So for me, my longs have to be inside of a discount, and that's like common trading knowledge: buy low, sell high. So if I'm going long, I want to be under 50%, which we were not at that given time. If the market is trading from a discount and trading higher inside of buy side liquidity, then that means that we're trading into a premium, and that's where I want to be taking my shorts. And let's go on the 1 hour chart. I mean, the 1 minute chart real quick. So this right here is that 50% mark. So if we traded above 50%, right, at 9:30, we typically know the best trades happen in between like 9:50 through like 10, the first 15 minutes of 10 o'clock, right? So if I know that, and price is trading in a premium at that time, running buy side liquidity, then there's no reason in my motto of trading to go long inside of a premium when grabbing buy side liquidity. Because if you know, the best longs always happen in a discount after grabbing sell side liquidity: buy low, sell high. So my thought process was, okay, we're trading higher, we're taking out these buy side highs right here, right? Took out these highs, and I was kind of expecting it to take out this high, but since we didn't take out this high and we took out these ones, that's okay with me. That's fine. For my motto, price, for me to go short, price has to trade into a premium and take out a buy side high on the hour chart. So since these are its own buy side highs, I didn't demand it to take out these highs, but I was expecting it to take out these highs, if that makes sense. So after taking out those highs, right, we have a low right here, taking out this high, an internal sweep on liquidity. After that internal sweep on liquidity, we have an aggressive break down, taking out this low, switching market structure, changing the state of delivery. After that, we have a run higher, trading into a premium of this range right here. If I pull out my fib and you measure the range, the 50% level is right here. And we traded above that 50% level and traded inside this small fair value gap right here. A small fair value gap. And then after trading into that fair value gap, what do you see? You see a breakdown, and then you see another aggressive breakdown, leaving more fair value gaps. At that moment, I'm seeing that price is rejecting off buy side liquidity inside of a premium, which is an overbought condition. If price is trading into a premium and grabbing buy side, that is an overbought condition. So I'm seeing that price is rejecting away from that. So when I see price rejecting away from that buy side and started coming down, displacing, making more fair value gaps, I went short inside of this fair value gap. So I waited for price to come inside this fair value gap. I'm gonna play it. Boom. So now I'm in short. And I also like that price didn't trade inside of this fair value gap right here and respected this one. That lets me know that I'm on side with the market. And then you see we have a nice displacement right after trading inside that fair value gap. And I'm also targeting this low right here on the hour chart. I'll let you know why I'm targeting that low on the hour chart. So if price came, right, if price traded from a discount to a premium and took out buy side a 1 hour high, then I'm expecting it to come take out its 1 hour low that started to run higher to that high. So that's why my my buy side was that low and it's coming back into a discount after trading into a premium, taking out buy side liquidity. So you also have some lows right here, right here, right here. Those are good for partials, but my full pull take profit, if I'm leaving runners, it's going to be down at this low right here. We have another fair value gap. And let me explain something real quick. One thing I like about this fair value gap is it was at 50% of the range. So this fair value gap was formed at 50% of that big range on the hour chart. And since that fair value gap is right there and this 50% level is here, I'm expecting the 50% level to act as resistance. So once we trade below the 50% and trade back into it, I'm expecting us to use it as resistance. And that's why you see the bodies of these candles are respecting that 50% level. You see we got an aggressive break right here. We have some breakaway gaps that's not getting filled in. Price trades into this fair value gap respected. And this is where I took all of my profits and I left a little bit of a runner down to like right here, and then I closed my full position. And yeah, so basically that's how I was bearish on this day. If you need one more little cleanup, I'll explain it to you right here. So a lot of people thought that we were bullish on this day. If you take away these two black candles and just look at this price run right here, I'll show you on the 5-minute chart. So if you take away this right here, people thought that we were bullish on this day going into that buy side. But if we're looking at the market when it's approaching a certain level, and when it gets to a certain level, you have to see how it acts, right? So we're trading into a premium, taking out this buy side. I have to anticipate us reversing rather than just keep going higher. I can anticipate both, but in this situation here, we took out the buy side and then we broke. We traded back into a premium fair value gap and we broke. So that's not giving me the signs of a continuation. That's giving me signs of a reversal. And then we have displacement here, more fair value gaps. Respect of the fair value gap, another displacement, another fair value gap, another displacement. So it's giving signs of reversal. So you have to anticipate. You can't just always expect price to do what you think it's going to do. You have to anticipate off these certain key levels. And that's how you would get better at catching the daily direction on any given day, just using basic premium discount and liquidity. I'm saying that's it. That's really it. I'm saying not that hard. If you want more videos like this, like the video, comment. I'm saying subscribe, and I'm gonna catch you in the next one.